Emily, you have nailed buy quality, buy America, try to push aside all the noise. We've re-noised after the first week of August. How do you reset for 2025?
We continue, Tom, to have our eye on the ball here. We are continuing to emphasize high quality stocks. We think we're in this late cycle environment where the lagged impact of Fed tightening hasn't tipped us into recession. We continue to spend like crazy in the United States. Not a political statement, by the way, it's just happening. And that's extending the cycle. We want to be careful of reaching too far for risk. We want to start even legging into some more defensive parts of the market. And we continue to want to embrace the income that's available now in high quality bonds.
For you guys at State Street, what is quality, legging into the quality part of the market? What does that mean for you guys?
Yeah, so it's companies with great balance sheets. They have a ton of cash, great return on equity. Think about a company with a limited need to tap the capital markets in order to grow. And with the cost of capital still elevated, companies are now contending with margin pressure. Revenue growth was awesome during the height of the pandemic as companies could pass those higher prices along. Now record revenue growth is slowing, margins are compressing, and the companies that are going to do the best are the ones that can defend those margins. And we're finding a lot of that in the quality factor and most notably in technology.
Emily, it's away from your remit, but let's keep the theme going. I need a hat trick right now. And that is, we had two opinions earlier this week, separate and discrete, reaffirming double-digit earnings growth. I assume you're there, but can you state to us that you see persistency of quality margins that lead to double-digit earning growth?
Yeah, I think you can find it, but it's going to be concentrated in those companies. Luckily, the quality factor has concentration in mega cap tech. And of course, those names are dominating the market. If you look at earnings growth just this quarter, half of it was driven by the communication services and technology sector. Revenue growth is coming from those areas of the market. So as long as you can see that holding up, I think you can get there. Now, Tom, the great news is the bar for Q3 is really low. Analysts are penciling in 3.8% year over year earnings growth. So I think we should just enjoy it while we can. Like you guys are enjoying the Yankees right now, beating the Red Sox. Like enjoy it while you can.
Emily, you're killing me. Stop it.
We might get better.
I mean, you could see from the new John Hancock, if you go up higher, you could see the lack of offense up at Fenway. It's like a cloud over Fenway Park. Paul, NVIDIA, you were on this.
Yeah, so
from the peak down 21%.
I know, and Tom raised a great question, Emily. If you think about NVIDIA, think about AI, that's been such a driver of the stock market performance for the last almost 2 years here. If the AI trade is kind of played out, does that bring some risk into the marketplace that we need to account for?
Yeah, it does because of that concentration. And look, we're bumping up on 30 times forward earnings for the U.S. technology sector. That's about as high as we've gotten over the course of this cycle. Now, of course, it's not the 50 times forward earnings we saw in the late 1990s, but certainly there's been a lot of multiple expansion there. The good news is if you do the math, you guys seem to be doing a lot of math this morning.
Yeah,
so let me just get in on the party.
2 + 2.
If you look at the PE ratio, we would focus on the denominator. Look at the earnings, and you can blame a lot of things for any reset in the technology sector, but it's multiple compression. It is not earnings. The earnings are there. The fundamental case for AI is there. It's just the love affair with it is probably a bit extended.
Paul, NVIDIA, 56 times PE, forward PE only to January of next year is a 42.
Yeah, and it gets to a 30 handle on the following year. So this is a company that's earning its way into its multiple. That's what the bulls will tell you here.
Exactly.
Exactly. So, I mean, this Federal Reserve, Emily, it seems like it's ready to begin a cutting cycle. How does that kind of impact how you guys are thinking about stocks, bonds, commodities, all that kind of stuff?
Well, Paul, it comes down to what's already priced in to the bond market. The bond market is putting pressure on the Fed right now because we've got 5 rate cuts priced in for this year. So if you start to hear the Fed coming out on next Wednesday as even a little bit more hawkish than what's already priced in the market, I think you might see a repricing there. You'd see bond yields backing up. That would likely cause the dollar to appreciate. It would put some some pressure on equity markets very likely here. So we've got to hear a more dovish Fed just to fit in with what the market is already pricing in.
Right. What are you doing with cash? I got 30 seconds. Cash, 5%. It's going to be 4.99%. What happens, Emily Roland?
Yeah, cash is subject to massive reinvestment risk here. We would go out into the belly of the curve, lock in higher rates there. The ag is yielding above 4%. Still get it while you can. Income, get paid to wait.
Emily Roland, thank you for the brief.